You may recall that in Session 6, you were introduced to traditional IRAs, including how to handle distributions from these plans. My purpose here is to show you how to report tax-deductible contributions to a traditional IRA so that the money will be available upon retirement. It's important to note that this adjustment does not include contributions to Roth IRAs, 401ks, 457s, or simple plans. Roth IRAs are ignored because their contributions are not tax-deductible. Instead, any earnings in a Roth account are tax-free. 401ks, 457s, and simple plans are tax-deferred and deducted by the employer. Because they are deducted from taxable earnings in the W-2, they are not deducted under adjustments. Otherwise, they would be deducted twice. On the other hand, contributions to a traditional IRA are made with tax dollars, so we need to deduct them in order to get the tax-deferred advantage. Of course, to deduct an IRA, the client or taxpayer must have taxable compensation. If they or their spouse, in the case of someone married filing jointly, do not have any taxable compensation, they cannot deduct money for an IRA. Examples of taxable compensation include wages, salaries, commissions, fees, tips, bonuses, and yes, even alimony. The amount of the IRA contribution to be deducted may be limited depending upon a couple of factors. If the taxpayer and/or the taxpayer's spouse had a pension plan at work, then it affects the amount that they could deduct. Also, the amount of their adjusted gross income will dictate how much they can deduct, since there is a phase-out limit that changes annually. The IRS has predetermined contribution limits that taxpayers are allowed to contribute to an IRA. For instance, when they first came out in 1979, the limit was $1,500 per year. A few years later, it was raised to $2,000. Since then, it has been raised a number of times. A taxpayer can make contributions to a traditional IRA at any time in the tax year up until April 15th of the following year. Often, when you're showing a client their income tax situation, particularly if they are getting a refund, they'll decide to place money in an IRA. As long as they state that the transaction will take place before April 15th, you'll want to update the tax return to report the increase in deductions. A common way that people set up an IRA is to buy a certificate of deposit at a bank. They see the investment as secure with guaranteed interest, but the growth can be relatively small. Other taxpayers put IRAs into mutual funds of some sort. They can also be in stocks and in some bonds. If a client asks you how to set up an IRA, refer them to their bank or financial planner in order to get the answers they need. Is it possible for a taxpayer to change a conventional IRA to a Roth IRA? Yes. In most cases, they can do so by calling the custodian of the IRA, which is most likely the bank or the mutual fund company, and ask them to convert their IRA into a Roth IRA. Of course, when they do that, they will need to pay the tax on the money that's converted. Why? Conventional IRA contributions were made prior to taxes. There was no tax paid on that money. Roth contributions are after-tax contributions. So, if I'm moving it from a conventional IRA to a Roth, I have to pay the tax on it so that the playing field stays even.